Hi, I'm Jay Prakash. Welcome to our series on smarter fixed income investing with bonds. Stocks are exciting, gold feels glamorous, real estate seems tangible, but bonds, many people think they are boring. But here is the truth. Bonds are stable, strategic, and smarter than you might realize. In this video, we'll explain how bonds work, their returns, the risks and rewards, and why they deserve a place in every investment portfolio. So what exactly are bonds? Simply put, bonds are loans. Let's break it down with an example. When you take a loan from a bank, you pay interest on what you borrow. Now flip that. When you buy a bond, you become the lender. You lend money to a government or a company and they pay you interest, called the coupon, at regular intervals. You also get your invested amount, which we call principal, back either periodically or at the end of the bond's term, depending on its structure. Still unsure? Let's clear up with some common myths. Myth 1. Bonds are boring. Well, sometimes boring means reliable. Bonds provide stability and can protect your portfolio during stock market ups and downs. If you value steady, less stressful returns, bonds might just be right for you. Myth 2. Bonds are only for older people. Not true. Bonds can fit many financial goals. You're looking for a passive income? Bonds can help. Saving for a specific goal? Bonds can help. Want to diversify and reduce volatility? Bonds can help. They can support salaried workers across age groups, freelancers, homemakers, and retirees. Bonds often provide returns that help reduce reliance on your salary or business income while aiming to preserve your capital. Why include bonds in your portfolio? They offer a secondary income stream. They are less affected by the market swings compared to stocks, gold, or real estate. They provide annual yields typically ranging from about 6% to 14%, depending on the bond's risk level, though higher yields generally come with higher risk. They have defined terms and repayment schedules, so you can align them with your financial goals. They help preserve capital, especially when investing in high-quality government-backed bonds. Most importantly, they diversify your investment mix for better balance. Every investment, including bonds, carries some risks. Here is what to watch. Default risk. Here, the issuer might fail to pay the interest or principal on time. Liquidity risk. Some bonds might be hard to sell quickly at a fair price. And the third one is the interest rate risk. When a market interest rates rise, existing bond prices can fall. Now let's talk about returns. Two main factors affect bond returns. One is the issuer's credit rating, and the second one is the bond's duration. Government securities like treasury bills or government bonds usually offer safe returns around 6 to 7%. Corporate bonds are usually carry a little bit higher risk and they provide varied yields. A AAA rated bond could offer yields somewhere between 7 to 8% on an annual basis. A AA rated bond could give you a return somewhere between 8 to 10%. A A rated bond could give you somewhere between 10 to 12, and a BBB rated bond could give you returns between 12 to 14%. Now, what are the benefits of the bonds? One, it's fixed returns, which means it is less volatile compared to other equity classes. Second is the predictable cash flows. And the third would be it always has some sort of collateralized security backing the bond. These qualities make bonds a strong choice for long-term wealth building. No matter your risk tolerance, conservative, moderate, or high risk, there's likely a bond that fits your goals. So how should you allocate the bonds in your portfolio? Here is a general guideline. Keep about 20% of your investable assets in low-risk instruments like high-yield fixed deposits, treasury bills, or short-term, highly rated bonds. This segment covers your emergency fund and near-term expenses, maybe 6 to 8 months of cost. The remaining 80% can focus on growth, income, and capital preservation in different proportions depending on your life stage. Use diversified government and corporate bonds with 2 to 5 year durations for medium-term goals like education, marriage, or a home purchase. For long-term goals like retirement or legacy planning, consider long-duration corporate bonds alongside your equities and gold. Even if you are in your 20s or 30s, bonds can boost your emergency fund returns and reduce exposure to stock market swings. So what have we learned today? Bonds aren't boring, they are balanced and dependable. They protect your capital better than volatile assets, provide income, and bring peace of mind, especially when markets get rough. Thanks for watching. We'll see you in the next episode.